Two ways to make money in this world. You either offer your time or you take risks. And unfortunately, we have limited amount of time. So this feeling of urgency may make some investors YOLO into out-of-the-money call options with only 5 days till expiration. Some people make it, and much of the time they don't. Someone sold these calls to our friends at Wall Street Bets, so why don't we sell these calls instead of buying them? In my covered call video, I explained that a covered call is an option trading strategy where an investor owns the underlying stock and sells, or writes, a call option on that same stock. The word covered means that we already own 100 shares of the stock, which covers the obligation if the call is exercised. Call option gives the buyer the right to purchase the stock at a set price before a specific date. Since we are the seller, this means we are risking assignment on our 100 shares. If the stock goes past our strike price, we might get assigned and forced to sell our 100 shares at the strike price, even if the shares are trading for more on the open market. We risk missing out on capital gains. So why would I want to risk assignment on my shares? We are rewarded for taking on this risk with premium. When an investor buys our call option, they pay us premium to have the right to purchase stock. Instead of buying 5 days till expiration out of the money call options, we are now the ones selling them, which also means the probability is now in our favor. We can be the casino. Robinhood calculates the probability of profit for us for each option. We can also calculate weekly conditional probabilities ourselves using Python to calculate assignment risk. As the strike price goes up, the probability of success increases because the stock would have to go up even more within a week. But lower risk means lower premiums, so only sell options you are comfortable with. All options get their value through time, strike price, and implied volatility. The farther out the expiration date, the more valuable the option becomes because there is more time for the price to pass the strike price, increasing the probability of success. The closer the strike price is to the current market price, the higher the option would be worth because it's easier for a stock to go up 0.5% to pass the strike price than it is for a stock to go up 10% to pass the strike price. Finally, implied volatility. This is the market's expected price swings for a stock, crucial to check the IV of a stock before dealing with options. Check out my implied volatility video to learn more. So, we understand what a covered call is. But what if we don't have the capital to open a covered call position? We need 100 shares of the underlying stock to sell one covered call. If we want to sell an Amazon covered call to make passive income in the short term while holding Amazon stock because we believe it will appreciate in value long term, then we would need around $21,000. This is where the poor man's covered call comes in handy. We can buy a deep in the money long leap call with a distant date till expiration. This will act as our collateral at the fraction of the price compared to owning 100 shares proper. The delta of the option tells us the option's price expected change for every dollar move in price of the underlying asset. For our long leap, a 70 delta is a good starting point. Next, we can sell call against our option leap for premium income. We want to only sell calls with a strike higher than our leap position. In case of assignment, at least your leap is in the money at a lower strike price, enabling you to exercise and buy 100 shares to fulfill our call that we sold. Though, we would rather roll the option we sold at a loss instead of exercising our long call, since our long call could appreciate in value over time. Alright, so to recap, traditional covered calls can be expensive to start because we need 100 shares to write options. The poor man's covered call enables us to buy a leap call to act as collateral for a fraction of the price, to then write calls against for premium income. So, what's the catch? The poor man's covered calls comes with more risk, because the underlying stock must go up over time in order for the leap call to appreciate. If the underlying stock goes down or even sideways, we lose. We can see optioncalculator.com and notice how Amazon stock has to go up in price just to break even on our long leap call. This means we need strong conviction that the stock will go up over time. Plus, options expire unlike traditional shares. The biggest risk is assignment on our short call without the proper 100 shares to offer up as collateral. In cases like this, it's best to eat the cost and roll up our short call to a higher strike to avoid assignment. We would hate to have to exercise our long leap only to then sell the shares away to fulfill the call we sold. Plus, we want to avoid exercising our long call because we still have time value. The extrinsic value of the option is higher farther out the date till expiration. So here are some potential scenarios of the poor man's covered call. I like Amazon stock. They're benefiting from the AI economy through AWS, but also robotics and their fulfillment centers. I believe Amazon will go up to 250 in the long term. So why not benefit with some exposure to Amazon while generating premium? Amazon current IV is lower compared to the 252-day moving average. So if we believe in the law of averages, Amazon's IV may increase back to the average over time, increasing the value of our long leap option. Say I buy a Amazon long leap expiring in 2027 with a 190 strike price. I sell weekly or monthly calls to generate premium income. Let's say I sell the 230 call expiring in 5 days. If Amazon stays below 230, then the call we sold expires worthless and I keep the premium without assignment. We can sell another call for next week. If Amazon goes above 230, then the call we sold is in the money. We would eat this loss to avoid assignment. We will roll up to a higher strike price and collect premium again, cushioning our initial loss. For the option setup, a leap call with months or years until expiration with a 70 delta is a good starting point. Our short call will be 5 to 45 days till expiration, which serves as our premium income. Some traders close their short position after making 50 to 75% of the profit on 30 to 45 days till expiration short calls to lock in the premium and sell a new short call. Or, instead of worrying about managing options, we can just buy the S&P.